I love Las Vegas. I'm sure you do too. But are you gambling with your overall retirement? Does it feel like when the market shakes, you're on the roulette wheel? Do not let that happen to your retirement, folks. Welcome. Show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner, president of Pure Financial Advisors. One more time. And this show wouldn't be a show without the big man. There's Big Al Clopine. He's sitting right over there. We'll get to him momentarily. But if we wrap up 2018, we had a fairly volatile year. We've seen some huge shifts in the overall markets, 4%, 4.5%, 4.16, and the big one here, December 26, 5% movements in one day. We are extremely volatile territory. It looks like an EKG. This is Big Al, right? When he looks at the market, are you freaking out? You cannot freak out. You need a plan. That's today's Financial Focus. Good news, though. Kiplinger came out with a report. They looked at people under 50 and over 50. Still a lot of work to do, but if I look at this, people under 50 are getting their financial act together. 85% of these individuals are saying, you know what, I'm going to work as long as I can. But if I look at over 50, only 67%. You're tired. I get it. I don't want to work. I want to retire. But look at this. It doesn't make a lot of sense. Only half the people are maxing out their 401k plans. They don't want to work longer, and they don't want to max out their plans. But people under 50, they're taking advantage of the employer plans. Looking this, having a financial planner. 70% of people under 50 are taking advice. Only 58% of people over 50 are. You need to have a plan, folks, to get you to your financial goals, to live that financial freedom. Do not go to Vegas with your overall retirement plan. Let's bring in the big man to sort things out. Big Al Clopine.
So today we're talking about not leaving your retirement to chance. And the way that you do that is you have a plan. You have a plan for cash flow, what you're going to be spending in retirement and where that money's coming from. You need to have a plan for taxes because you want to minimize your taxes so you can spend more for your own retirement lifestyle. You need to have a plan for investments, how you're going to invest to last a lifetime. Then at the end, we're going to get into the retirement roulette wheel. We're going to spin it and talk about life events and what to do when those happen. And Joe, it's one thing to have a plan, but there can be things that happen that aren't expected.
The problem is that you can have the perfectly laid roadmap, right? And obstacles will jump in at you at any moment.
Yeah.
So we're going to spin the wheel, and then we'll figure out what bad things are going to happen to us.
Yeah.
And what steps that we need to take to fix it.
So that'll be a little morbid, but we'll learn about what to do.
Yeah, it's the wheel of death.
Yeah, right, exactly. But for now, let's get into cash flow.
Let's do that.
So let's talk about where you should be at various ages. And Fidelity does a really good each year. They kind of give you an estimate of what you ought to have. And take a look at this. Age 30, 1 times your salary. Age 50, 6 times your salary. Make $100,000 times 6. You ought to have about $600,000. By the time you retire at age 67 is what they're showing, which is Social Security age. It's 10 times.
A lot of times you're thinking, hey, am I on track, given my certain age? Hey, I'm in my 30s, 50s, 60s, whatever. Am I on track? Well, this is just a good gauge just to let you know, hey, what nest egg do you need to provide you an income stream to last you the rest of your life? So if you're approaching or you're knocking on retirement store, you're in your 50s, you're thinking, hey, how much should I have at this point? Just multiply your annual salary by 6. If you make, like Al said, $100,000, you should have $600,000 liquid at that standpoint. Alan, let's take a look at a quick example here. Let's say if you want to spend $75,000 a year, every year for the rest of your retirement, let's say the next 30 years. We talked about the rule of 4% or the 4% rule. And what that means is that you don't want to take out any more than 4% out of your liquid portfolio. So let's look here with this couple. So first thing that you want to figure out is your fixed income. What is going to come to the household as a fixed income stream, such as Social Security, such as maybe a pension, or maybe you have rental income that is giving you cash flow. So if I add that up, they're giving $30,000 in Social Security plus another $20,000 of additional cash flow from pensions or real estate. So that's $50,000 that's coming in. But they want to spend $75,000. So what you need to do to start your overall strategy is to say, what do I want to spend? What is going to come into the household? And figure out what my shortfall is, $25,000. So then, all right, this needs to come from the overall portfolio. In this example, let's just assume this couple has $800,000 saved. If I divide this $25,000 into the $800,000, their distribution rate is 3.1%. Or say it another way, 3.1% of 800,000 equals $25,000. This 3.1 is under that 4% threshold. So we feel, hey, these individuals are probably on track.
Yeah, I would say so too. And we do talk about the 4% rule, and it's not a perfect rule. I mean, in some cases it's not going to be enough, and in some cases it's plenty, right? So it just depends. It's kind of a starting point. But a lot of folks, when they go through this, they realize, wait, I'm not there. I'm not that close. And so then what can you do to make your situation better? Well, some obvious things. One is you can work longer, so you can save more to get to retirement. So that's one thing. Or maybe you've got some kind of job or interest where you can make some part-time money throughout retirement, at least a chunk of retirement. You may have to look at your expenses. Maybe you got to reduce those a little bit. There's things like deferring Social Security, downsizing, and reverse mortgage is yet another one to where you could potentially get your mortgage to go away and have a payment stream. So there's a number of ways to make your situation better. And I think, Joe, that calculation is where you start, and then you start coming up with a plan to get there if you're not quite there.
A few small things that you can potentially do when you get into your planning, and we talked about this, is control what you can control, right? You can control your spending, you can control your savings, right? You can control your risk, how your portfolio looks. We're going to talk about that when we get back from the break. But another big component is taxes. Where is your money held? Is it in a tax deferred like an IRA or 401k pool? Well, no, all of these dollars coming out is going to tax at ordinary income. Tax-free is zero. Taxable is a little bit more favorable. So now you're putting all the pieces of your puzzle together so you're not at Vegas, spinning that roulette wheel. You have a solid strategy. When we get back, we got Brian Perry. He's a CFA. He's a director of research at Peer Financial Advisors. He's going to break down some investment strategies for us. And of course, we got the roulette wheel coming up later. Don't go anywhere. We're just getting started. Show's called Your Money, Your Wealth. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson, Big Al hanging out, talking about Vegas today, getting excited. We got Brian Perry. He's a CFA, Chartered Financial Analyst. He's a director of our research there at Peer Financial Advisors. He's going to be joining us momentarily. But before we get into all that good stuff, let's see how you did on the true-false question.
When the stock market takes a sudden dive, your greatest chance of investment success is to sell your stocks and move everything into cash and bonds. And I'll start with that one. Now, this has to do with your investment style. If you're selling out of the market completely, that's market timing. My preference and my strong belief is that long-term investing is a better way to go. I think 60 or 70 years of academic research indicate that and sort of prove that to be true. What do you think, Joe?
Well, the better strategy is to get out of the market and go into cash and bonds before it goes down.
If you could only tell when.
Well, right? Who doesn't know that answer? When it already goes down, then that's when you panic and sell, and we all know that is a recipe for disaster. So it'd be great if we knew right before it was going to go down, then we could sell, but unfortunately, no one knows that. No one has that crystal ball. And if we had that crystal ball, I'll tell you what, we wouldn't be here.
And Joe, I think it's a matter of controlling what you actually can control. And one thing you can control is the amount of investment risk in your portfolio. And so there you take a look at how much you need in stocks versus bonds. And we've got a little illustration here. 20% stocks, 80% bonds. That would be a relatively conservative portfolio. On the other end, 80% stocks and 20% bonds at the bottom. That's a much more aggressive portfolio. So you have the ability to control how much risk you're taking in your portfolio.
Yeah, the problem is that you have to figure out exactly what target rate of return that you're searching for. right? So it's like, okay, well, do you need 6% in the overall portfolio, or do you need 8, or do you need 3? You have to get the plan in place first, so that's going to devise your overall investment strategy. And sometimes if you feel like you're a little bit behind the 8 ball, you haven't saved enough, the tendency is to take on a little bit more risk because we like those big returns. But guess what? With big returns come big losses. So you just want to understand exactly what you're doing. What is the volatility of the overall portfolio? And can you stay in your seat when we're seeing the volatility like we've seen over the past, 12, 16 months? That's the problem, Al. It's like people want to bail out. They love the returns, but the risk scares the heck out of them.
Well, they do. And so then it's all about determining what rate of return you need based upon your goals. So that's really what it comes down to. And then when you figure that out, you still have some work to do. You can't just kind of do it and then sit and then do nothing. You're going to need to rebalance from time to time. And rebalance just simply means you may have like a 60-40 stock portfolio, 60% stocks, 40% bonds, but then it may drift a little bit. Let's just say 70% stocks, 30% bonds. So now you're taking on more risk than you need to be and should be because the stock market has done well. So you want to rebalance. You want to get back down to the 60%. You shave some of those gains to get back to 60%, forcing you to sell high and then buying the lower ones, in this case is bonds.
Alan, you're a CPA, right?
I am.
And I'm a certified financial planner. I think it's time we bring someone on that knows exactly what they're talking about when it comes to investments.
Couldn't agree more.
I think you're pretty good at taxes.
Yeah.
And I'm pretty good at probably...
And financial planning.
A little bit, right? So let's bring him on. Brian Perry, he's a chartered financial analyst. He's director of research at Peer Financial Advisors. He's going to break things down like never before. Brian, welcome aboard, my friend.
Brian, thanks so much for joining us. And based upon recent volatility and some downturns in the market, how should we be adjusting our portfolios, or how should we be setting up our portfolios in this kind of market?
No, that's a great question. And of course, it all begins before the market falls. Once something's happened, it's too late. And I'm big on learning the wisdom of the ages. And so I fall back on that famous philosopher, Mike Tyson. And Mike Tyson said that everybody has a plan till they get punched in the mouth. And he was referring to boxing, but I think it's the same thing in the financial markets. Markets go up most of the time, but they do fall, and they fall sharply, as we've seen. And you need to be prepared ahead of time with a plan. And that plan should involve some sort of honest assessment of how much risk you can take in your portfolio.
Well, I think that's right, because we know the market's going to decline. It's just a matter, are you prepared for it?
Yeah, markets go up and they need to go down, and people forget about that. We had a pretty good run for about 10 years, and I think a lot of people got overly aggressive. They got excited about the prospect of making more and more money. We saw quite a rally last summer, and then it came to a screeching halt.
So we all would like to control the stock market, but we cannot. But what can we control?
Well, again, you can start with the level of risk that you're taking in the portfolio and make sure that that's appropriate. And then things like your bailiwick, which is taxes, right? A falling market isn't fun, but it does present the opportunity to maybe do some tax loss harvesting. That's something that can be controlled. Rebalancing to make sure that the risk profile is appropriate can be controlled. And then most importantly, make sure you're an investor, not a trader. And a lot of people confuse those two. I think, to be honest, in my opinion, that's the biggest mistake people make, is that they think that they're investing and they're actually trading.
And so what does that mean, to be an investor versus a trader?
So to me, traders get out there and they compete with professionals. And by professionals, I mean hedge funds, people with PhDs from MIT and Stanford, and reams of computers and fiber optic cables to speed their orders to the exchange floor. And then an average individual sitting at home in front of their computer tries to compete with them by speculating on what's going to happen in the short term, which is really just the theory of what is somebody willing to pay for something tomorrow. As opposed to investing. Investing is relying on the long-term upward progress of the economy, the fact that over time corporations generate profits and that those profits translate into higher stock prices. When you do that, you're not competing with anybody. You're just participating in the forward progress of humanity.
Well said. Now, our tendency, of course, in these kind of markets is to want to become more conservative. Markets go down a bit, and it's like, ooh, I can't afford to lose any more money. Is that, and that's what our emotions tell us to do, but is that really the best course of action?
Well, it is perfectly natural to feel that way. It can be frightening. I mean, when you watch your wealth start to disintegrate, it's scary. And so it's important, again, to check back on why you own these things. And most of the time, it turns out that you own stocks or whatever's falling a lot for the long run. Even if you're already retired, you probably expect to live another couple of decades. You may not need the money from your stocks for 10 years or more, right? So a lot of times, and it sounds counterintuitive, the best thing to do is actually to buy more stocks. That's that rebalancing process where if stocks have fallen sharply, you sell some of the bonds or whatever you have in your portfolio that's done a little bit better, and you replace it with some more stocks. Again, buying low, selling high.
That's hard to do, though. Buying when the market crashes or goes down, it takes a disciplined plan.
Oh, absolutely, and it's contrary to human nature. In a lot of ways, our human brains are our worst enemies as investors. And I think that's one of the benefits of writing something down on paper. And that could be a really robust financial plan, or it could be the back of a napkin. But if you have something that you can refer to in writing, it makes it a little bit easier to fight your emotions and stick with what's actually going to work for you in the long run. And the other part is, turn off CNBC or the Wall Street Journal or whatever source of news you get, because they're being paid to attract eyeballs, and they're going to flash up every bad news headline. And there's a lot of studies that show that viewership of those kinds of things goes up tremendously when markets fall. And of course you're going to be nervous. You're already nervous because your portfolio fell, and now you're being bombarded with negative headlines, and it just becomes self-reinforcing.
So don't succumb to the noise and have a great plan. Try to stick with it. Brian, great information. Joe, back to you.
Great stuff, guys. Awesome stuff. Hey, we got to take a short break. We'll be back in a second. You don't want to miss this segment. We're going to break out the retirement roulette wheel. You have the perfect plan. We're going to spin the wheel and blow up your retirement. We'll figure out exactly what you need to do to fix it. Don't go anywhere. Show's called Your Money, Your Wealth. Welcome back to the show, folks. Show's called Your Money, Your Wealth. We got the roulette wheel, retirement roulette. We're going to spin the wheel here in just a second. But before we do that, let's see how you did on that true-false question.
The cost of a long-term care stay is covered by Medicare if you are over 65 years of age. And the answer to that is false. A lot of people don't realize that long-term care is not covered by Medicare. And so you need to have a plan for that, whether it's long-term care insurance or whether it's your own savings or maybe you sell your home. You got to at least be thinking about that.
Yeah, Medicare will only cover a very small fraction.
Yeah, it's 100 days actually in certain cases, right? So it's anyway, there is a little coverage, but not several years or even months.
Speaking of wonderful things that could happen to your retirement, what we did here today was we put together the retirement roulette wheel. What this is that you could have a perfectly laid out plan, right? You have enough savings, you're living life on the beach, everything is great, family's wonderful. And then the wheel happens. What could happen to your retirement? Oh, early retirement. Alan, early retirement. So what does that mean? Well, 60% of people or something like that, 50% of people are forced into an early retirement.
Yeah, Voya did a study and found out that 60% of the people out there retire sooner than they want to. And why? It's because it's health issues, or maybe they need to care for an ailing parent or an ailing spouse, or maybe they lose their job. There's a lot of reasons why you don't work as long as you expect. And so you need to have sort of a plan for that.
Guess what else could blow up your retirement? Spinning the wheel. Outliving your savings.
Oh, that's a tough one.
What do you do there, Al?
Well, there again,
eat fatty foods, smoke a bunch of cigarettes.
Yeah, that's one way to do it.
It's just shorten your life expectancy and you're good.
Or you could actually have a sensible cash flow plan. We talked about the 4% distribution rate. So look at your spending goals, look at your fixed income, see what's left over, divide it into your investable assets, and then you want to make sure it's below 4%. And if you're there, you have a really good chance of not outliving your money.
Yeah, I think that the game here is just to look at, do you have a strategy? Do you have a plan in place? Because that's the biggest fear of all of us approaching retirement, is that you don't want to outlive your savings. Let's see what else can happen to your overall retirement. That's what's this? Oh, high medical expenses.
Oh boy, there's another one, right? Because Fidelity each year, Joe, comes out with a study, and they recently looked at a 65-year-old couple, and they're estimating that the medical costs and health insurance is going to be $280,000 over your lifetime. Of course, then, Joe, you hear that number and you freak out, but it's easier to think about it annually. It's about $5,000 per person per year.
Yeah, but we talked about long-term care. There's all sorts of different things as we get older. The good news is that we're getting older. right? The bad news is that we're getting older. The older we get, right, things are going to break and we're going to get sick. And some, you have to really take a look at what these medical expenses could do to your overall plan. Let's keep spinning this bad boy here. Isn't this fun? All right, outliving your savings. We already went there. Let's spin it again. What do we got? Ooh, long-term care, already took that. Spin it again. Ooh, disability.
Oh, disability.
Oh, boy.
That's a tough one. And I actually just saw a recent study that estimated that a 35-year-old has about a 50% chance of being disabled for 3 months or longer by the time they reach age 65.
That's a wonderful statistic.
Yeah, so I've already made it to 61, so I'm pretty good.
But when you look at, let's say if you're younger, the largest asset that you own, right? It's not your home, it's not your retirement account, it's your ability to earn an income. So you want to make sure that you can protect that income as much as you can. So there's disability insurance, you want to make sure that you have enough cash reserves and so on. Let's do this one more time. What do we got? Divorce. Oh, Jeff Bezos, speaking of. That cost him a couple
That can be one of the most expensive things that ever happens to you. And I think right off the bat, of course, you got to figure out how to split your assets. And I think, Joe, a lot of people don't realize that when you're splitting your assets, some assets are more tax efficient than others. For example, if there's $500,000 in a retirement plan and $500,000 outside a retirement plan, well, the dollars outside of a retirement plan are more valuable because they've already been taxed. So just make sure you're including the taxation in this.
Huge mistakes happen there too, because usually one spouse will want the house and the other spouse will want the retirement account. You have to take a look at the after-tax value of your assets. And then guess what? You only have half the assets now, and is that going to be enough to maintain your overall lifestyle? So that's retirement roulette, folks. There's a lot of things that can throw a curveball in your overall retirement strategy. You just want to make sure that you have contingency plans for everything. Let's switch gears here. Let's see, there's some experts around here that you guys have questions for, so let's go to Ask the Experts.
Hey guys, I was wondering if the money that we're saving for our grandkids is going to impact their ability to get a scholarship in the future.
What do you think, Joe?
Well, I don't know. I guess it depends on what type of scholarship it is first.
Well, that's true. Merit-based or financial-based.
Right?
Yes.
Or, they could be a star athlete.
Sure. And then it doesn't matter.
Then it doesn't matter. Or if they're looking at maybe financial aid, is it going to affect their ability to get financial aid? It could. It really depends on where the titling is of the money.
So if it's in their name.
Right. If it's in the grandchild's name, then they're going to count that as the grandchild's asset.
Right.
Such as a, education IRA, maybe a 529 plan, things like that could affect their ability to get financial aid. But when you're looking at scholarships, that's, we'd need a lot more information
it
there.
depends.
But just like with everything else, right?
Always.
Let's see if we can give another phenomenal answer to this email question.
I'm in my late 30s and I have only saved about $35,000 for retirement. I want to be aggressive moving forward. Are target dates a good option for me? What say you on that one?
Let's say, late 30s, $35,000. Target date funds. Well, let's explain what a target date fund is first. Is that you can pick a fund. Most of you might be familiar now. They came out in the Pension Protection Act of 06, and it just allows a portfolio inside, let's say, your 401k plan to kind of shift and move as you age. So maybe you want to retire in 2040. So the allocation of that target date fund is going to have probably more equities than bonds. But as you get closer to that target date or your target date retirement, then it's going to get more conservative as you get older. So if you're 30 years old, $35,000 is a target date fund pretty good? Yeah, why not? I mean, it's just on autopilot. I think that's a great choice. Just make sure that you pick a long target date out there so you have more equities. Or you could just say, you know what, I just want to put everything into a S&P 500 index fund, and I think that would be suitable too.
Yeah, and I think you also want to make sure if you do pick a target date fund, make sure that the internal fees are not too bad. Many are cheap, there are a few that are expensive.
Yeah, just like with everything else, you just want to do your due diligence and make sure you know what you're doing. All right, let's go to the peer takeaways. first things first, you want to make sure that you get a plan in place, right? Know what you need to know, right? When do you want to retire? How much money are you spending? What is your fixed income sources? Have a tax strategy. Make sure that you understand the taxation of the income that you're going to receive in retirement. Understand your investment strategy. Manage that risk as much as you possibly can. And if all of that is perfect, guess what? The roulette wheel is going to come and blow you up. So you want to make sure that you plan for the unexpected events. That's it for us. Hopefully you enjoyed the show. I sure did. For Big Al Clopine, my name's Joe Anderson. You just watched another phenomenal episode of Your Money or Wealth. Have a wonderful weekend, everyone. Cheers, bud.